Hello, everybody. Welcome to the webinar we're doing tonight. I just want to go over an opportunity that we're working on right now. It's called Apollo Meadows. It's a 72-unit building that we're gonna go through it in the slides, go through the details of everything that's going in here, introduce you to the team. This is something that I'm actually really excited about. Compared to a lot of the projects, actually every project I've ever done that's been a syndication, the timeline on this is nice and short. I believe, Paul, it's 15 months. Is that correct?
Correct. Yep.
Yeah, 15 months. So normally you're waiting 3 to 5 years to turn your money, and anyway, it's just a great opportunity. And we'll go over the project through the slides. I don't want to give away too much right off the start. So this is our team that we're working on. This is something that I believe in. I'm working as a co-GP. I've worked with most of these people before, and we've done some projects, and we want to just continue the success onto the rest of the projects, including this project. Paul, if you want to just introduce everybody to the team, and then we'll go through the slides.
Yeah, perfect. Yeah, hello everybody, and thank you for joining. So my name is Paul Hopkins, and I am the VP of Investments at CPI Capital. So it's my responsibility to basically find the deals, secure them, underwrite them, and then go through with the overall asset management. So my background is construction and engineering. I grew up basically swinging a hammer with my family, doing my own fix and flips, and then eventually moved into apartment syndication about 10 years ago. And during that time, I was also getting involved in different development projects and such. And today's opportunity is right at my heart. I love construction, I love development, and this is where I really love these types of projects. The rest of my team is August Binez. He's the Chief Investment Officer. So he and Ava are both located part-time in Naples, Florida, and the other half of the year in Vancouver, British Columbia. So with August, he, his background is in development as well. Being a custom home builder in Vancouver for many years, and then back in 2020 decided to start up CPI with Ava Benasaki, and then from there has grown a significant portfolio that you'll see on the next slides. We have Ava Benasaki, who's our Chief Executive Officer. She's got a background in real estate, starting off as a real estate broker in Vancouver, getting to the top of the brokerage with top sales and such, and joining August to form and build up CPI from the ground back in 2020. And so many of you may know Ava from speaking engagements and such, and basically the face of the company. And then, of course, we have Josh Melanchek, who is our investor relations manager. He's a registered dealer here in Canada, and he could help answer with any questions that you may have. So with that, that's the team, and we can move on to the next slide.
All right, so this slide just really represents CPI Capital's assets under management, which is roughly around $180 million, totaling just over 800 doors. Now, before we move forward, I do want to briefly touch on the disclaimers included in this presentation. Please note that you'll want to review these slides in full on your own time, as they do outline very important assumptions, risk considerations, and projections related to the investment opportunity. As with any real estate investment, actual results may vary, and nothing presented tonight should be considered a guarantee of future performance. All right, now jumping into the executive summary, this slide really captures why we moved aggressively on the Apollo Meadows and why we believe it aligns perfectly with our investment thesis. First and foremost, this is a build-to-rent strategy in one of the fastest growing corridors of San Antonio. We're entering this project with fully finished lots and horizontal infrastructure already in place. This dramatically reduces entitlement and development risk and allows us to begin vertical construction almost immediately after close. So this really de-risks the investment for investors. What we really love about this location is the demand drivers. The project sits near major employment anchors, including the Joint Base San Antonio, Port San Antonio, and key transportation corridors like Loop 1604 and the US 90. That creates a deep and stable rental pool for exactly the type of product we're delivering. The next point on this slide here is demographically, the area fits our target residential profile extremely well. There's strong household incomes, growing family populations, and demand for attainable housing options. So we have our 3-bedroom duplex product is designed specifically to meet the demand gap here. And importantly, this is where the short duration strategy becomes compelling because we are underwriting conservatively with a target exit price of around $250,000 per unit, which is $500,000 per duplex, which is below the market comps, which is always great to see. At CPI, we always are looking for opportunities where we can limit the downside risk while maintaining strong potential upside. And Apollo Meadows really checks all the boxes there. Now, this is the heart of the opportunity, what gets us really excited, why we love this deal, and why we believe Apollo Meadows fits today's market exceptionally well. First, this is not a speculative development strategy. One of the strongest aspects of this project is the pre-sale structure. Units are being pre-sold during construction to established real estate investors, which are the end buyers, turnkey, which significantly shortens the whole timeline. And that's what's going to really accelerate the capital velocity and reduce exit uncertainty. That's a major part of our thesis here, is creating a faster path to liquidity rather than waiting for years of stabilization. Second point here is we absolutely love the market fundamentals. The far west side of San Antonio continues to experience tremendous population and job growth, supported by major economic drivers like the Joint Base San Antonio and continued infrastructure expansion throughout the corridor. We're investing where people are moving, we're investing where jobs are growing, and where housing demand continues to outpace the supply. From a risk perspective, Apollo Meadows is also highly attractive because we are acquiring, as I mentioned before, fully finished construction-ready lots. So that eliminates a large portion of the entitlement and the infrastructure risk that you typically see in ground-up development deals, which makes them ultra risky. And the last point here, finally, we've structured this project intentionally for capital efficiency. We're utilizing institutional construction financing with conservative underwriting and a very clear debt paydown strategy through unit sales. This is going to help us minimize refinance and long-term interest rate exposure. Next slide here. So one of the biggest reasons we had conviction in Apollo Meadows was the strength of the local operating partner behind the project, Invest5S. In development, execution is everything, and we believe, partnering with a group that has deep boots on the ground experience in Texas significantly reduces this operational risk. So Invest5S it brings over 30 years of experience. They've done over 4,000 developed lots in the region, and they're vertically integrated. So they have development, brokerage, and property management as part of their firm. What we also like is that they're a family-owned business with a strong reputation in the San Antonio and Dallas markets. They really do understand the local buyer profile. They really understand the construction environment and the demand trends extremely well. So we're really excited to be partnering with them again. Another thing too is in 2026, they're on track to deliver hundreds of units in 2026. So it's really not their first time trying to figure out this process. They have an active pipeline and a proven execution history. This slide really highlights another reason why we have strong conviction in Apollo Meadows. We already have active projects with Invest5S. Execution is tracking exactly as planned. Apollo Oaks, this is the deal I was talking about that we closed on last year. It's a great example. This project, we closed in San Antonio with Invest5X construction, development timelines, and pretty much overall execution is progressing extremely well. For us and for investors that are on the call tonight, track record is extremely important. In real estate development, we always say there's a huge difference between projection execution and proven execution. We always want to see a partner successfully operating in real time, not just presenting, a business plan on paper. So here we wanted to give you guys like real-time look at the development progress on Apollo Oaks. These are actual pictures from Apollo Oaks that are showcasing the current stage that the property's in. And I always say what our team looks for is, are we on budget and are we on time? So what's encouraging to see these photos is the project is, on schedule and within budget. So this next slide here is examples of past projects. So this really goes to show you that Invest 5S has a substantial track record. It's not their first rodeo. Here it's just highlighting that they've built small projects all the way up to very large projects. I mean, 14 units all the way to 330 units. When we were down in San Antonio, we went and drove around these properties. We met with Invest 5S service providers and other stakeholders, and they come highly recommended. And they do have an amazing, great reputation in the San Antonio market. All right, now getting into the project itself, Apollo Meadows, it does consist of 37 duplexes for a total of 74 units, all designed as attainable 3-bedroom product with garages, which continue to see very strong demands from the family in this submarket. One of the key advantages here is that we're acquiring fully furnished construction-ready lots with the horizontal infrastructure already in place, already completed. And that allows us, again, to go vertical immediately at close. That's why we have this 15-month term. It's a quick project that we're going to be turning around here. And this project is going to be built in 2 phased construction cycles over the 15 months, which deliveries actually begin at the beginning of 2027. More importantly, units are expected to be sold during construction to the end buyers, with closings occurring at certificate of occupancy. Next slide here. I'll go over the investment summary. Investment type, this is a build to rent, build to sell development. Showcases the location in San Antonio. It's on 4.5 acres of land. Number of units is 74. Finished unit size is actually 1,250 square foot per unit. Estimated project timeline 15 months, and expected completion date is August 2027. So the LP IRR is forecasted to be 25.1%. ROI is 31.3%. LP equity multiple is 1.31x. Average annualized return is 26.7%. Our minimum investment is going to be $50,000 USD, and the investment offering is open to Canadian and US accredited investors. On this slide here, one more thing I wanted to highlight was, it's not on the slide, but I wanted to make mention of, is the opportunity is going to be eligible for anybody using their registered funds for Canadians or retirement funds for Americans. So for our US investors, that's going to include self-directed IRAs or 401ks. And for our Canadian investors, eligible accounts are RRSPs, TFSAs, RESPs, LIRs, RIFs, pretty much anything you have that's a registered account you can invest through. I always, talking to investors, investors are very asset rich, but they're cash poor. So when they realize that they can deploy registered funds, retirement accounts into the real estate opportunities like Apollo Meadows, it does become a very attractive option for a lot of investors. Very important slide. Let's talk about debt. The loan type is a construction financing. We're getting a $12 million construction loan. Loan to cost is going to be 81% of the total project, 84% of loan to cost, excluding any carry costs. Interest rate is a 9.5% construction loan with fully funded reserves. So that's 100% of the sales proceeds pay down the debt, eliminating refinancing risk over the 15-month term. The fees is a 1% financing fee, and it is a fixed interest rate for the loan term. So I just want to highlight that. It's a fixed interest rate. So everyone's always concerned, of course, about variable mortgages, and this is a fixed rate for our construction loan. Okay, now let's get into the capital stack. So one thing we always like to prioritize is alignment and investor protection here. And I'm going to break this down in a very simple way. For this offering, there is only one investor class available, the limited partner Class A shares. Class A investors sit directly above the construction debt in the capital stack, which is a very strong position from a risk perspective. So I'll explain how it works. So as each home is sold, the proceeds are distributed in a very clear order. First, the construction debt gets repaid. Second, the LP investors receive their 12% preferred return hurdle. And after that, profits flow through the waterfall structure, which I'll walk you through on the next slide. Importantly, the GP only participates in profits, of course, after the investors receive their 12% preferred return. Investors always typically like to see this structure because it creates that strong alignment. The GP performs well only when the investors perform well. Another point here on this slide is that we're highlighting is the GP also contributes capital to the deal alongside the investors, as we strongly believe in having, meaningful skin in the game with the investors. So this is the waterfall. First off, investors get paid a 12% preferred return. The first hurdle is return of capital. So after they get paid their 12% pref, investors get their initial capital that they've invested that gets sent back to them. Hurdle number 2 is anything above that 12% all the way to 25% IRR gets split 50-50 between the LPs and the GP. And hurdle number 3 is anything over 25% IRR gets split 30% to the LPs and 70% to the GP. This page here really highlights an example based on a $100,000 investment over the 15-month hold period. $100,000 represents your initial investment capital. $31,300 is the anticipated distributions of excess cash flow from the unit sales after each initial capital repayment and all project costs. So a total of $131,300 sum is all the cash flows to the investors at the end of the 15-month hold period. So now I'm going to pass the mic to August to go over his chapter of the presentation. Thank you.
Oh, again, thanks for being here. And I want to go over the BTR model. Some of our investors that are currently on the call are very familiar with the BTR model, but for those of you who might not be familiar with what BTR is, I just want to touch on it on a high level. Build to rent is when investors build purpose-built rental communities of single family or duplexes. Now, triplexes and quads and townhomes built for rent also fall under the umbrella of BTR. But if you're building multifamily or other types of structures, that is not really considered BTR. BTR is really distinguished by its property type. I want to break down the consumer demographic for BTR and the economic drivers behind this asset class. Build to rent is one of the fastest growing sectors in U.S. housing, emerging as a distinct institutional asset class alongside multifamily, student housing, self-storage, industrial, hospitality. The Urban Land Institute is forecasting that a BTR sector is now amongst the fastest growing segments in residential real estate. The demographic that BTR is serving is renters by choice. Over 1/3 of the American population rents, so 342 million people and over 100 million Americans rent. Over 10% of the US population lives in apartments, so that's around 35 million Americans that live in apartments. And majority of that number are renters by necessity, but BTR serves around 5 million Americans who are renters by choice. These are individuals or families who can afford to purchase a home, but choose to rent because of lifestyle flexibility. They don't have to be stuck in a 30-year mortgage. They can move if they wish without having to sell their home. They can live in a maintenance-free home and community. For baby boomers, they love living in a house or duplex and have the security and convenience of a garage. They don't have to, have someone living above them, living below them. Boomers who are downsizing and moving to be closer to their grandkids also love BTR. BTR serves millennials who are now forming households. They're married, having kids now, and are in need of larger space. But as a result of elevated mortgages and home prices, they are not purchasing homes. They're not purchasing homes. BTR also serves Gen Z, the young professional cohort who, unlike their parents, like to rent and be more mobile. They can live in Texas for a few years, live in Florida next. They're a subscription-based generation where they know exactly how much income they make and they know a portion of that income goes to their rent. An interesting fact about renters by choice demographic is that they are stickier tenants than their renters by necessity demographic. They stay longer, which reduces turnover costs for us as investors. And they have pride of ownership, and they cause less wear and tear in the property. And they are less delinquent on their rents, which all results in increased net operating income and profit for us and our investors. Another tailwind for BTR is the current elevated mortgage rates, which I touched on a moment ago, which have created a $650 delta to purchasing a medium price home compared to a medium rent for a similar property. This is a nationwide stat, but here on the slide, you can see that the same delta exists for San Antonio, which is around $500. So it's cheaper to rent than buy. Last point on this slide that I wanted to make is major institutions have been investing in BTR, and they're expanding their allocations, such as REITs, funds, and private equity shops, because the asset class really provides a flight to safety where investment firms can achieve value add, more risky type of returns, but for a core, which is a less risky type of asset. So I just want to make light of those important points. The BTR, next slide, please. The BTR value proposition. What we really like about this opportunity is that it sits at the intersection of affordability, demographic growth, and long-term rental demand, which is exactly where we believe build-to-rent sector performs best. At roughly $1,650, you can see here $1,650 attainable monthly rent. We believe that the product is positioned very competitively within the San Antonio market. Tenants are getting significantly different lifestyle experience compared to traditional apartments. A 3-bedroom home, 2.5 bath, attached garage, private entrance, and much more space and privacy. We believe this creates a strong middle market rental product that remains attainable while still delivering quality housing. The next point here is 90,000 medium household income. The specific far west San Antonio submarket we're targeting has an average household income of around 90,000 annually. That's important because it supports our rent assumptions from an affordability standpoint. At these income levels, our projected rents remain well within healthy affordability range for the target demographic that we're going after. This also helps create a more stable renter profile with stronger payment capacity and lower delinquency rate. The next point there is 12.7% local veteran population. And this is another major advantage of this location is proximity to Joint Base San Antonio, which is one of the largest military installations in the US. The military presence creates a very durable tenant base because these households typically prioritize quality schools, neighborhood stability, and long-term community living. Historically, military-affiliated renters also tend to demonstrate lower turnover and stable occupancy characteristics. Last point on this slide is 6.3% job growth. San Antonio continues to be one of the strongest job growth markets in Texas, even while some multifamily markets nationally are dealing with near-term supply pressure. San Antonio continued population growth and employment expansion continues supporting long-term housing demand. This is especially important for build-to-rent because employment growth ultimately drives household formation and rental absorption. Next slide, please. So Texas overview, we'll get into Texas. I'm not going to over-litigate Texas as far as why we believe in Texas, but I'll cover some important points before going more macro. But before discussing the project specifically, I think it's important to understand the broader macroeconomic backdrop supporting Texas as an investment market. At CPI, we spend a tremendous amount of time analyzing long-term demographic and economic trends because ultimately those trends drive housing demand and real estate performance. And there are lots of interesting things about Texas here. If Texas were an independent country, it would rank as the 8th largest economy in the world. Its economy is larger than entire countries such as Canada, Russia, and South Korea. That level of economic scale is extremely important because it creates long-term resilience, diversification, and sustained housing demand. For many of our Canadian LPs, it's helpful to think of Texas less as a state and more as a major global economy just by itself. Texas continues to dominate the United States in corporate relocation expansion activity. The state is home to more than 54 Fortune 500 headquarters, including major global companies such as Tesla, Oracle, ExxonMobil, AT&T, American Airlines. These relocations are not just headlines. They directly drive job growth, wage growth, population migration, and ultimately housing demand. Texas also benefits from having no personal state income tax and no corporate income tax. That creates a very attractive environment for businesses, entrepreneurs, and households relocating from higher tax states such as California, New York, and Illinois. This migration trend has been one of the strongest drivers of Texas population growth over the last several years. Texas also benefits from enormous infrastructure advantages: 26 commercial airports, 23 seaports, 35 foreign trade zones, and one of the largest freight and logistics networks in North America. This makes Texas a critical hub for international trade, manufacturing, and supply chain activity. Next slide, please. I'm not going to spend too much time on this slide, but if you will send this presentation and replay back to you guys in a moment. But one of the reasons we remain highly bullish on Texas is because the state consistently ranks among the top business and economic environments in North America. Next slide, please. Where are all the U-Hauls headed to? So this is an interesting slide. One of the simplest ways to visualize migration trends in the United States is by looking at U-Haul data, essentially tracking where people are physically moving. According to the 2025 U-Haul Growth Index, Texas ranked as the #1 growth state in America for inbound migration. What's particularly interesting is that Texas didn't just rank highly at the state level. It dominated the metro rankings as well. San Antonio also ranked among the top growth metros nationally, benefiting from broader migration trend into Texas. Next slide, please. So we're going to get more macro into San Antonio here. While we're very bullish on Texas overall, we believe San Antonio specifically offers one of the most attractive long-term risk-adjusted housing stories in the state. The San Antonio Metro has now a population of 2.8 million people and continues to experience strong population and employment growth. Since 2020 census, the market has grown nearly 9%, making it one of the fastest growing major metros in the United States. Importantly, San Antonio still remains one of the most affordable large cities in America, particularly for renters. That affordability advantage is critical because it continues attracting families, businesses, military households, and residents relocating from higher cost markets. Next slide. I'm not going to spend too much time here, but you can see it's ranked top 10 for many of these, 7th most populated city, #1 best city for military retirees, #2 for millennial growth, but I'll allow you to take a read on that when you get a moment. I think this is an important slide here. Another reason that we love San Antonio long term is because it serves as a major transportation and logistics hub within Texas and across North America. The city sits at the intersection of several major interstate corridors, including I-10, I-35, and I-37, connecting Mexico, the Texas Triangle, Gulf Coast ports, and major U.S. population centers. Importantly, this infrastructure supports continued corporate investment, manufacturing growth, logistic expansion, and long-term employment growth. For housing investors, strong infrastructure and transportation connectivity are critical because they help support durable economic activity and population growth over time. Next slide, please. For the airport expansion, I'm not going to spend too much time here. I'll allow you to read it, but if you see an airport expanding, you know that city is definitely going through a growth phase, $1.4 billion airport expansion project. We'll go to the next slide, please. I think this is important because it affects Apollo Meadows, I think that this is significant for this submarket because a significant infrastructure investment occurring across San Antonio transportation corridor. The I-10 and I-35 expansion projects are designed to improve traffic flow, freight movement, and long-term regional connectivity, throughout some of the busiest corridors in Texas. These highways are critical economic arteries connecting San Antonio, Austin, Dallas, Houston, and Mexico. Importantly, Apollo Meadows is strategically positioned in the far west San Antonio growth corridor, directly benefiting from these long-term infrastructure improvements. Next slide, please. Now let's zoom in on exactly where Apollo Meadows sits. The site is at 47445 Grossenbacher Road in San Antonio's far west corridor, one of the metro's primary residential expansion zones. Location is everything for sales strategy, and this is one of the well-positioned. This is well-positioned here for us. Port San Antonio is about 17 minutes away, and both downtown San Antonio and the international airport are 25 minutes away. The renter and buyer demand here is anchored by real employment. Joint Base San Antonio supports more than 82,000 military personnel, civilians, and contractors, and generates $55 billion in annual economic impact in Texas. The local demographic supports our product. The San Antonio MSA is 2.8 million, as I discussed earlier, and the median household income for our zip code is $90,000. A qualified stable base for our 3-bedroom and 2.5-bath product. The site also has direct access to major corridors, the US 90, Loop 1604, and SH 211, and it's benefiting from ongoing TxDOT infrastructure investment and school district growth, both key drivers for housing demand in this corridor. The takeaway here is that this is a deliberately chosen location, close to jobs, growing infrastructure, and the right income demographic to support both our rents and our exit strategy. Next slide, please. For the major attractions, I'm not going to spend too much time on these slides, but we have the Six Flags there. We have the San Antonio River Walk, which we enjoyed walking and going to restaurants. Next slide, please. The Alamo. So if you're an investor in a certain tier in Apollo Meadows, you'll actually get an invite and have all of your flight taken care of to come to San Antonio and meet us at the mansion that we're going to have for our groundbreaking ceremony, I believe sometime in July. So we'll have festivities, the groundbreaking. You'll spend time with us at the mansion, and we'll bring our general contracting partner to do a presentation there as well, and lots of food and lots of fun. So we'll get a chance to go to the Alamo as well, because since it's a UNESCO World Heritage Site, so we'll do a tour there. You have the SeaWorld San Antonio, and yeah, please speak to our investor relations team about that point that I just brought up. SeaWorld San Antonio. Next slide, please. So we have San Antonio Rodeo. We've attended it. It's truly mind-blowing how large the lands are there and all the different events. San Antonio Spurs, the NBA team. You have the shopping at La Cantera, where it's a high fashion district there, and lots of top hotels in San Antonio as well. This slide is pretty important, so I want to spend some time on this slide. So Project Marvel is one of the largest redevelopment projects in San Antonio's history, representing over $3 billion in combined public and private investments, centered around new downtown arena for the San Antonio Spurs. The project is expected to transform the downtown hemisphere district through a new NBA arena, mixed-use development, hotels, retail, restaurants, entertainment venues, office space, and new residential housing. A public and private funding commitments are already in place, including voter-approved county funding, city infrastructure investment, and significant private capital, a commitment from the Spurs owner and development partners. Next slide, please. Golf and mini golf. They're San Antonio's world renowned for golf and mini golf courses. I'm not going to spend too much time on this slide, but the next slide is pretty important if you could go to that. Population growth is ultimately one of the most important drivers of long-term housing demand, and San Antonio continues ranking amongst the fastest growing cities in the United States. Since 2020, the San Antonio New Braunfels MSA has added more than 205,000 residents, with majority coming from out-of-state migration. Importantly, this is not just organic growth. People are actively choosing to relocate to San Antonio because of affordability, job growth, and quality of life. San Antonio also ranked number 4 nationally in numeric population growth from 2023 to 2024, ahead of many major US cities. For Apollo Meadows, this is directly supports our BTR thesis because population growth ultimately drives household formation, rental demand, and long-term absorption for attainable housing product. Next slide, please. The economy is very diverse. If you compare it to cities like Orlando, where the economy is really dependent on tourism, for example, here in San Antonio, unlike many other markets that rely heavily, like I just mentioned with Orlando, San Antonio benefits from broad employment across healthcare, government, logistics, financial services, manufacturing, education, and professional services. Next slide, please. These are the top performers. So you got performers, you got manufacturing, trade, transportation, utilities, you have business and professional, you have education and health. Next slide, please. This is a very important slide, and it really cements our case about the market. So if you look at the graph on the left, and I think before I get into the graph, I also want to touch on that the case about San Antonio is because it doesn't fall under the boom and bust type of cities that are that have the tendency to have a concern with boom and bust cycles. Cities like Phoenix, Las Vegas, even Orlando. These cities, when the market is doing good, they do really well. But when the market is not doing very well, they actually go through a bust cycle, which is not very good for investors. So San Antonio, if you look at the graph on the left, this compares year-over-year GDP growth across major Texas metros in 2023. What's important here is San Antonio ranked near the very top of the state in overall economic growth performance. That tells us the local economy was still expanding at a very healthy pace despite a broader environment of higher interest rates, inflationary pressure, and slower national economic growth. In other words, San Antonio was not just growing, it was outperforming many other major Texas markets during a more challenging macroeconomic environment. Now, the graph on the right is arguably even more important from a risk management perspective. This measures GDP growth deceleration, essentially how much each market slowed down from 2022 to 2023. The smaller the slowdown, the more resilient the economy. Many markets across the country experienced significant economic deceleration as capital markets tightened and growth normalized post-COVID. However, San Antonio ranked as the most resilient large Texas market with one of the smallest GDP deceleration in the state. What that tells us is that San Antonio's economy is not only growing, but is also demonstrating stability and durability through challenging economic cycles. We believe much of that resiliency comes from the city's diversified employment base. For Apollo Meadows, this is very important because resilient economies tend to support more stable rental demand, lower volatility, and stronger long-term occupancy performance. I'll go ahead and pass it to Paul here. Thank you.
Yes, thank you, August. So now we've covered the market and the partnerships, and now I want to walk through basically the actual product, the site, the homes, our budget, and the data behind the underwriting. So this is the part of the deal where I talk about more the conservatism and how this really shows up. So I'll take a few minutes over the next couple slides to explain that in more detail. So this is the project site. It's located at 4745 Grossenbacher Road. On the left is the approved site plan, and on the right is a current aerial photo of the project. So the layout is 37 duplex lots organized along two internal streets, roughly on 4.45 acres of land that is being developed. So you'll notice a blue line along the western edge of the property. This is the FEMA 100-year floodplain. The buildable lots are on the outside of that line, and all the drainage designs and engineering has accounted for where this is located with regards to the drainage. The aerial photo site shows the work that's already in progress, and the horizontal developer is currently completing all the horizontal infrastructure. And so when we acquire the site, it's going to be fully finished, construction ready to go lots. The property specifications include 37 duplex lots, which it's 74 total units. Each unit is 1,250 square feet, which is a 3-bedroom, 2.5 bath, 1-car garage. Construction quality is built for durability and lower operating costs to the end buyer. So we've got hardy siding, concrete slab foundation that is engineered for the lot, wood frame construction, copper and PEX plumbing. You'll see that the project amenities listed as none, and that is intentional. This is a fee simple for sale duplex product. There is no pool or clubhouse or shared common areas, and that helps bring down the overall cost and to build and to maintain. So this keeps our basis lean and the project attractive to actual end buyers. So each unit still comes fully finished with LVP flooring, stainless steel appliances, private patio and yard, and contemporary finish package. So these are the actual architectural floor plans of the duplex units. So the first floor is an open concept living with family room, kitchen, dining, plus the 1-car garage and a powder room. The second floor holds all 3 bedrooms and the 2 full baths, including the master suite. So it's an efficient family functioning layout across 1,250 square feet, designed to deliver basically space for families that want, without having that unnecessary additional cost. So these are the exterior details of the actual product. I mentioned hardy siding before. This reduces the overall insurance costs and provides superior weather resistance. We've got concrete slab foundation, 30-year composite shingles for long-term roof durability, quality weather-resistant exterior paint, which that helps reduce maintenance needs. Each unit includes a 1-car garage with an EV charger that helps with the future expansion of technology. Of course, we have garage door openers for added convenience, and each unit comes fully landscaped with front and backyards. Some select units having some tree coverage for added curb appeal. And each unit will have their own backyard, which offers privacy and outdoor living space, which is a key differentiator from traditional rental units or apartment units. The interior itself is thoughtfully designed with high-end finishes like LVP flooring downstairs, carpet upstairs, faux 1-inch wood blinds throughout the home for privacy, granite countertops in the kitchens and bathrooms, stainless steel appliances, smart technology package, including keyless door entry, a smart thermostat, a hub panel. There's obviously safety-focused features, smoke detectors, ground fault interrupters, and privacy locks. Noise insulation, because this is a duplex, noise is a concern that we're addressing. And so we have, between the 2 units, we have that noise insulation to enhance the living experience, ensuring overall quieter and more private environment compared to the general older stock. And all the entry doors have a solid core with added security, the deadbolt, adding deadbolt locks installed on all exterior doors as well. So this slide talks a little bit about the risk mitigation assumptions and how we think about the risk. So the headline is conservatism on both sides of the model. First on the cost and on the revenue or the sales of the units. So on the revenue side or the sales side, our targeted exit price is at $249,500 per unit or $499,000 per duplex. So that's modeled roughly 8% below the market comp average of $272,000. So we built in this, $272,000 per unit. And we built in this downside protection from the start. Our pro forma rent is underwritten at $1,650 per month, which is also below the local comparative average of $1,688. I took a broad approach, looked at around 27 active listings that were available for rent within basically 3 to 4 mile radius, and came up with that local comparative average. And I'll get to those details on another slide. On the cost side of things, we have fixed price contracts, or also known as gross maximum price construction contracts. We also built in a cash reserve buffer, and we're fully funding our interest reserves at close. So the vertical construction is sequenced in 2 phases, and I've modeled in an S-curve draw schedule to limit the peak equity exposure. And if you don't know what that is, I have created an underwriting video that I dive deep into the underwriting itself. And that video is available for all investors that are interested in seeing how I created the underwriting model and how I made these assumptions, including what an S-curve draw schedule looks like. All right, next slide. This is our overall project timeline, and this timeline is, established with our development partner, Invest5S, and this isn't just pie in the sky type of assumptions. These are well-known key deliverables that Invest5S has been able to execute over and over again with their actual development projects. So once we acquire the land, which we're targeting closing at the end of June, since we are acquiring these finished lots, there's zero entitlement risk, no permitting delay, and we could go vertical immediately at close. We've phased our vertical sequence into 2 6-month phases. Phase 1 being 19 lots, starting in July, going to December of 2026. And then phase 2 is the remaining 18 lots from January through June of 2027. The home sales will follow on a rolling basis with each one of those phases. Phase 1 closings in early of 2027, and phase 2 closings in mid 2027. The duplexes themselves will be pre-sold during construction, and each sale will occur at the certificate of occupancy stage. So this phasing matters. It helps reduce the peak equity exposure, and it's allowing phase 1 sale proceeds to actually fund the partial of phase 2 development. This is the same timeline, just shown on a Gantt chart. So it gives you a different perspective of how this is built. So it's a 15-month total forecast from land acquisition to the final distributions of capital. So the key milestones to follow, we've got phase 1 vertical sales, phase 1 vertical start, followed by the pre-sales to the end buyers that run concurrently through construction. Once phase 1 is done, then we start with phase 2 vertical. And once phase 1 is also complete, that's when the sales and occupancy starts for the phase 1. And once phase 2 is complete, then that's when the sales of phase 2 happens. Once all the lending has been paid off, that's when the distributions are made back to the investors. So an important point here, all the units are pre-sold to our buyer network during construction. So we're not building in a speculative hope for a demand at the end of the project. So, we've got a well-established buyer network, and our development partner also has a credible Rolodex of investors that typically buy these units from them. So let's look at how this project is capitalized. So the total project cost is $14.74 million. The construction debt is $12 million, which is about 81% of the capital stack. So Ava talked about that earlier on. That includes the construction loan plus fully funded interest reserves. The LP equity, which is $2.74 million, which is about 19% of the stack. That's the equity that we're actually raising in this offering. So, and then additionally, we have a modest debt-heavy structure on a overall short duration. And this for sale product is exactly what amplifies that equity return at the end. So the debt is also self-liquidating from that sales. On the uses slide, there's quite a bit of numbers here, but the land and associated development costs are about $6 million, which is about 41% of the budget. The land itself is $4.625 million. The hard costs are at 8.14. That's 55% of the budget. And it's worth noting that this line is entirely vertical construction. The horizontal construction shows a 0, and that's not an omission. That's because these lots are being delivered fully finished lots. So we don't have to fund for grading, for roads, for utilities. That's all de-risked from the deal, and that will all be completed by the time we close. So the balance is the soft costs, carry costs, and other financing fees built into the budget. This slide ties the per unit economics together. So the vertical construction is $110,000 per unit or $220,000 per duplex for a total cost of $8.14 million. The targeted sale price of $249,500 per unit or $499,000 per duplex has a gross projected sales price of $18.46 million. So we've budgeted disposition cost in realistically, which is 7% of the sales cost and another 6% for title transfer and the end buyer rate buy down. And I'll come back to that shortly on another slide. So the spread between the 110,000 build costs and the 249,000 sale price, even after all those costs, is where the investor returns are generated. So our underwriting isn't really built on optimism. It's built on data, hard data that we have, from our development partner and our experience so far with Apollo Oaks, our current development deal, and also the current economics that this property is located. The far west San Antonio submarket shows consistent absorption of suburban rental product. So we benchmarked Apollo Meadows against an established universe of 25 local comparables, and these comps average at about $16.88 a month in rent, and we underwrote the rents at $16.50. So there's deliberately below the actual market. So there is an assumption of built-in margin of safety. This is for considering the end buyer that is going to buy these, and they're buying these for cash flow purposes. So our numbers on the sale and the rents are based on cash flow projections. So as long as we're below the actual market, the absorption should be there, and easily be able to rent these units for profit price. So this is a maturing submarket with enough depth to support the family-sized duplex product for a stable workhorse to middle-income renter base. And as August mentioned before, there's so much economic growth and infrastructure growth happening in this actual submarket. Grossenbacher Road was something that we didn't really touch on, but they're doing a major expansion of that road, widening it and connecting it to other major intersections. So it is going to become a major route, which this property is just located off of. So more development happening in this area, which is exciting. This is the detailed comp set for rents. So looking at the nearby properties averaging under 3 miles from our site, the comp average at $16.88, where our pro forma is at $16.50. Again, it's intentionally conservative. You'll see the rent per square foot looks a little higher at $1.32, but that's simply because these units are efficiently sized at 1,250 square feet. And what matters to a renter is more the monthly rent check, which sits below that market average. So the mix of duplexes and single family comps here is real, demonstrating the demand at our price point. So, with some honest context on the rental market, San Antonio did enter into 2026 in a late stage supply digestion phase. There was a significant amount of development that happened in San Antonio in 2024 and 25. And that did take a while to absorb, but the near-term rent growth is modest because the market is absorbing that supply right now, and there is nothing on the new bill for new construction projects, and it's declining very, very rapidly. So that's going to ease the overall pressure. So the long-term fundamentals remain really strong, anchoring in at that 6.3% annualized job growth. CoStar forecasts, which CoStar is a reputable third-party analytical program. They forecast showing that rents are recovering really well, and it's going to continue to grow strongly over the next couple of years. So this is why our overall for sale strategy, with a very short-term hold, is very favorable. So we're not just dependent on a multi-year growth thesis, but even so, we're our current pro forma rents of 1650 sits below that average comp set that you find there today. So there is a potential that this is still going to grow over the next 15 months. This is the sale comp data set. So the data behind really our exit price. So there's all these comparable properties, averaging around 272,000 per unit, where our target exit price is 249,000 per unit, which is about 8% below the comp average. And that gap is basically our downside cushion. So as with rent, our price per square foot reads a little higher because these units are a little bit smaller, but the absolute price of $499 per duplex is positioned right at the local entry home benchmark level, which is exactly where the liquidity is best. So we're selling these into a price band where the market has already proven that it will absorb it. Zooming out to the home values, and August touched on this a little bit in one of his previous slides, that the zip code is 78245, where the median home value is roughly 260,000, up more than 130% since 2011. So the household values are growing at a very good pace, with new construction along US 90 and the different corridors in that area, especially with Grossenbacher that is expanding. That's commanding higher home values at 280 to 380,000. So our exit price at 249 per unit sits on the affordability into that range, not at the top of it. So this chart just shows the demographic shift. By 2029, household concentration is projected to grow meaningfully into the 300 to 400,000 and the 400 to 500,000 brackets, as these corridors densify and take on more population. The JBSA, which is the Joint Base San Antonio Proximity Data Centers that are to the south, being invested and developed right now. In migration from higher cost Texas metros, and the limited housing supply that is happening through 2026 are all reinforcing our price stability at the exit price. And of course, we stress test our model so you can see how the returns hold up if things don't go as planned. But our base case is the 6-month construction phases. So each phase being 6 months each, $110,000 build cost and a $249,000 sale price. So the target pro forma is the 25% LP IRR, or 1.3 equity multiple and a 31% ROI. So if you look across the tables, even with a 5 to 7% construction cost overrun, and keep in mind, we're on fixed price contracts, so we don't expect this to happen, but I just wanted to showcase this as well, that even with the construction cost overrun or construction timelines extending well beyond, the LP returns are still very positive, along with the equity multiple holds. In our timelines, they're also based off of historical deliveries from our development partners, so we're pretty confident in the actual delivery of these units. So our base case, also considering the 249 exit price, which is still below that 272,000 comp average. So there's still, I'm still showcasing downside scenarios, but there are potential of these upside scenarios. Again, if you want to see more of these sensitivity analysis, I actually go into it a little bit more in my underwriting video that you can see the different models that I'm looking at in the different cases. And finally, the exit. So a key part to the liquidity strategy is making it easier for the end buyer to finance these duplexes. So we work with CMG Home Loans, which is a private lender located in San Antonio. We've had the opportunity to work with them and meet with them while we've been in San Antonio. They are a private lender with over 30 years experience, and they provide these loans on a DSCR type of basis for the end buyers, typically around a 35% down payment. And we've allocated 6% of the total sales revenue, which is about 1.1 million. So we've already factored that in from the sales, 1.1 million as an interest rate buy down, which makes these deals more attractive, increasing the overall cash flow to these end buyers. So that can bring the buyer's rate down to roughly 3.75 to 4.25. This is also based off of not SOFR or anything else. This is a private lender that has their own lending requirements, and they base it all off of DSCR. So as rents increase, that also helps with the affordability of these homes to the actual end buyer. So that buy down is actually a deliberate liquidity tool that we build into our model, and it helps lower that end buyer's monthly cost. It widens the overall pool of qualified buyers, and it helps accelerate our exit so that we can build these units and quickly sell and exit and return the capital back to the investors. All right. Well, thank you, everybody, for joining our presentation today. And I hope you enjoyed what we had to share here today for Apollo Meadows, our build-to-rent duplex development project. Keep in mind, this is a very short timeline with an experienced development partner. We're already working on another project with this development partner in the same market, and that project is actually going very well and successful. So again, you could scan the QR code here for your soft commitments if you are interested, and be able to reach out to Glen with some more questions, and that we're happy to give you any answers. Keep in mind, you can invest through your registered retirement account, so IRA, self-directed IRAs, or TFSAs and RRSPs in Canada. So that is an opportunity for everyone here to tap into your retirement funds. So you don't just have to invest with cash. There are many different options and vehicles for you to use on this investment. So with that, Glenn, hand it over to you for final thoughts.
So like, for a lot of people who are signed up to attend this webinar, I know a lot of you, and if you don't know me or don't have my personal information, do feel free to reach out. Like Paul was saying, if you click on or scan the QR code, you'll be able to get a link to the soft commitment page. It isn't legally binding. It's just to show you that you have some interest, and we'll have a start a conversation, answer some questions. If that QR code isn't working, just because this is a recording, please I did make a sub link that goes to the exact same place as well. So if you go to glensutherland.com /interested, that will take you to the exact same spot. So glensutherland.com /interested. But I think this QR code should work perfectly fine as well, but just in case you had an issue.